Hi, gang. Jeff Greenblatt here, and this is really the first video on my new Jeff Greenblatt video channel. I did a prototype of the gold market about a month ago just to prove it to myself that it could work, and I actually did say I'd put up something in the new year. But we're actually going to get started right now. And the reason that I picked the bond market to do my very first video because what you're looking at, bonds on the brink, is the single, in my opinion, the single most important chart in all of financial markets. You get this one right, and you're probably going to stay on the right side of whatever it is you're trading. But lots of people, they don't. Did you look at the bond market this week? No. Did you look at the bond market this week? No. Somebody needs to look at the bond market. Because when the bond market rolls over, it's going to take the stock market with it. When the Fed has its day every 6 weeks, they're talking about very short term interest rates. This 10-year note is what drives the economy. It drives interest rates on houses, loans, cars, everything. And it's a major contributing factor to inflation because when the cost of capital gets too high, Houston, there's a problem. Okay, so let me explain to you what's going on this chart. First of all, the brown line is an intermediate term trend line, and we just experienced a tremendous rally. The red line I'll show you on the next chart is an important support line. But what I've done is I've created something called the Gann calendar, which is, and I'm the creator of it, by the way, and not enough people know about it yet, but this is one of the most accurate tools you can get to navigate through financial markets on a daily and larger time frames. Okay, so the thing with the Gann calendar is a 360-degree wheel representing a circle, which represents the Earth's orbit, and each day of the year has a specific vibration. For instance, this high coming in on December 27th is the 276 DG vibrational day of the year. And what's not shown here is the fact that this is $7.67 up. So you got that 76 vibration working. Now, what I just completed, which is why this first video took so long, is my last manual, which is Deeper Mysteries of the Market Revealed, where we talk about all different types of circles, circles within circles, and all the different Gann numbers that he explains in his master coursework, but he doesn't really give you a practical application of it. So let me give you one right here. The bond market peaks at 276, drops to polarity a little bit low, but retests the high and the trend line on the 312 DG vibrational day of the year. What's the difference? 36 degrees, right? And this rally was 72, double 36, 36 multiple, 72 180 minute bars. Now, what's concerning me is that it stalled at this trend line. It comes down to polarity, is shaky, and then it goes and drops again. And this time we were able to form a parallel trend line to go along with the longer trend line. And you could see that it's really shaky right here. So let me show you how we got here and why we are here. This is what really, really concerns me. And here's that brown line. You see that intermediate line? So you could see that if it really wants to, it could continue going sideways, and it could take the Andrews channel and rally back up to here to a bigger polarity. It could do that. Will it do that? Nobody knows. All we know, it's in trouble right now, and we need to pay attention. Why do we need to pay attention? Because of this red line. This red line is a 10-year major support line, last touched in 2013. So now, see, I drew this. It was a 10-year line. Now it's an 11-year line. Now, some of you technicians will know that when a major support or resistance line is breached, it'll come back and retest it pretty quickly, which is basically what this one did. And this is 2.5 months. So I could say that the market had mercy on us and spared us for 2.5 months because this thing could have kept dropping. Now, there's something very interesting that went on with this rally as well, is that I told people in my Substack that we were going, once it started rallying, it was likely to have a happy days are here again rally. Where did I get that? For that, we have to go to the 1929 to 1932 crash leg. Here's the 1929 crash, a drop of 49% in 49 days. Now, that might have been significant to the traders who were at the bottom who knew how to sink that, but in another video, I'm going to show you how the first leg of the move is many times the harbinger of the calculations for the entire move. And not shown here is that in July 1932, when this bear market ended, it was 148 to 149 weeks, which sinks right up there with your 49% in 49 days at the beginning. But that's not why we're looking at this today. I mean, there's a lot of things that we can learn from this 1929 to 32 bear market. And to be honest with you, if I didn't study this chart the way I did, we wouldn't be talking about Kairos right now. Because the bottom line is that by the time April 1930 rolled around, this rally leg was 154 calendar days at the same time that it was 155 trading days off the top. Now that got me so interested that I was able to take Kairos to the 21st century. Now the reason that we're talking about this rally is that after the crash ended, the crowd thought the worst was behind them, that business was going to come back to normal. The light at the end of the tunnel, they never realized, was an oncoming train. And that's exactly the psychology that we have in financial markets right now. You had this great rally. The VIX is at all-time lows. The media tells you the Biden economy is doing just fine. People are going out and spending, and they're very complacent. They're not concerned too much about all the different issues in the world. And that's basically a manifestation of the complacency that's happening right now in the bond market. So is this bond market going to roll over right now? Nobody knows for sure. But the bottom line is that we are very, very close to that long-term support level again. And let me add this, that if you're going to look at Elliott wave, what ends up happening in these happy days are here again type rallies is that the one in 1929 and 1930 completely replicated the psychology that came prior to the 1929 crash. It was the roaring 20s, right? Okay, so what ends up happening that creates the third wave down is the expectations of the crowd who get very complacent and euphoric. They think the light at the end of the tunnel is good. They don't realize it's the train, but when the train starts rolling back the other way, that's when people panic. Okay, so I've done my first video. I want you guys to not be complacent. I want you to pay attention to the bond market because the way the bond market is situated right now, if it should really roll over, and I don't know that if it's going to come down to the low, if it comes down to the low and takes off again, or if it's going to go sideways, if it's even going to cover this Andrews bare channel. I do have training programs available. We have very many manuals available. There's no website to go to right now. I do have a weekly Substack, and it's listed under Greenblatt Research. And the bottom line is, if you want to get more information on what we have, send me an email at lucaswaveman@gmail.com. Okay, that's going to wrap it up until next time. Thanks.